Steve Leisman has more now on the market-moving actions by some of the world's big central banks and what's next for our own Federal Reserve.
Central bank developments in Europe and China highlight not just the difference in economic weakness overseas and strength in the U.S., but also the increasing divergence in interest rate policies. While the European Central Bank considers greater quantitative easing, the Fed just ended its QE program. While the People's Bank of China cuts rates, there's wide agreement that the Fed's next move is to raise them. But the Fed is carefully watching these overseas moves. It even debated at its October meeting whether to say in its policy statement that foreign weakness raised the risks for the U.S. economy. But will it keep them from hiking?
If things fall hard enough in Europe, as an example, then yes, I think it actually could attenuate the cycle in the United States. But we're talking about a backdrop that would have to have deteriorated in a material way.
Others have already changed their view. Citi moved ahead its forecast for the first rate hike to December 2015 from September. And money manager Jack Ablin said foreign weakness and central bank easing is going to make the Fed wary about moving too quickly.
I think the Fed recognizes that the risk of tightening too soon and ending up back in the ditch is much harsher than waiting too long and having to fight perhaps growth or inflation down the line. I think they would rather err on the side of too much ease and then, ratchet back than to tighten too soon and then really run out of ammunition.
All that global easing, Ablin says, is good for equities, but there are challenges. The dollar is strengthened against the euro as investors come to believe the Fed will tighten, that is, raise rates, and the ECB will ease further. It's a challenge to U.S. exporters and pushes down on inflation by making foreign imports cheaper in the U.S. Most likely, the Fed will watch to see if these actions by other central banks help their economies grow. If they do, the Fed will stay the course and hike rates next summer. But if global weakness undermines the U.S. economy, and if deflation overseas washes up on these shores, then the Fed could well hold off and stay at zero for a bit longer. For Nightly Business Report, I'm Steve Leisman.